Okay, we should be getting live here. And gotta mute my stream. Okay, cool. So, can everyone hear me? Okay, Brad, shoot a little hello out here, and we're gonna test our sound really quick.
Hello, everybody.
All right, sweet. And if anyone can just type in the chat, hello, and make sure that the audio is not too loud or too soft or what have you, and that it's nice and clear. That'd be great. So we are extremely excited tonight to have Brad here. So Brad is an investor out of Kansas City. He manages a fund of family capital. And why I'm extremely excited to have Brad on this call is because Brad is a biotech guy. Now, for those who know my background, I have, I guess, a tainted but also beautiful past with biotech stocks. Brad, I didn't tell you about this earlier, but in my early teens, I was 17, 18, 19. I actually ran up my portfolio from like under $10,000. I got up to 100 grand. You know, I was just kind of like hitting all these, the FDA phase 3 trials and just one after another. Well, then I got one that went sour and I lost 75% of my portfolio, game over.
Oh, no.
Yeah, it was absolutely brutal. And I've always had this passion though for biotechs, which just makes me so excited to be able to talk to you tonight and learn more about your story, and then also about your investing, and then talk a little about the industry as a whole, because biotechs have been red hot. It's been an industry that's been leading the way over the last I would say even up to 3 years. So it's extremely exciting to have you on. So Brad, I guess, kick us off. Tell us a little about how you got started investing and how you got into the biotech realm.
Yeah, thanks a lot for having me. It's really nice to be here. It's funny that you started off with that story. You're going to ask me, I think, how do you learn biotech investing? And it's actually the same as investing in general. The key is just to make every mistake under the book. And then once you've done that, you'll be in a pretty good place. No, it's really great to be with you. Thanks for inviting me here. I do specialize in biotech, and I've been a lifelong investor. I'm one of these people who, as a kid in the 6th grade, I had a custodial account, and I've always been completely obsessed with investing. And when I went to college, I studied finance and biology. And immediately after that, my first job out of school, I started working at a company called Franklin Templeton. I'm sure you've heard of them. It's a big mutual fund company. And that was a great experience because I had a chance to, learn. I didn't do biotech specifically there, but, as a first job out of college, it was a good way to learn about, fund management and just the investment industry in general. And so I did that for a few years, and then I was away from it a little bit. I went to Washington, and I worked at the U.S. Treasury Department for a while, and I did some things in politics. And during that, while I was always doing other things, I was always focused on managing money, and I always did it privately for friends and family and things like that. And about 6 years ago, I was in between jobs, and I thought, why not just make a full-time go of this? And so I talked with my family about it, and I moved back to Kansas City, which is where I was born and raised. And ever since then, I've essentially been running a family office. And, biotech is one of those things. It's hard to describe how you get into it. It's just kind of like one of those rolling stone things. It's like you said, the stocks are so interesting, and just throughout my life, you pick up one and then you pick up two, and then at some point, I don't even know how it exactly happened. I just started focusing on educating myself, and I started going to medical meetings and, reading up on a lot of books and, getting to know a lot of doctors and academic researchers and things like that. And one thing led to another, and here I am today.
Wow. So now I guess it's an important point that this has evolved over time. It's not like, you just took an interest in biotechs and then the next year you're trading these, kind of getting a little kooky like I was doing with mine. You've taken a very deep approach with, investing in biotechs. And I guess, talking about your strategy, When I was reading about you, you like a more long-term approach. Now, with me just saying, here, this news is going to come out, either this drug's going to get passed or it's not. Let's just go for all the eggs in the basket. How would you define your approach when you're looking at these companies?
That's right. Definitely a long-term investor. I try to hold, whenever I look for an investment, I try to hold it for at least 2 to 3 years.
Wow. Okay.
Yeah, and I know that's kind of different in biotech. A lot of people like to trade them like you just described, and my risk tolerance is actually a lot lower than I think your typical trader and especially your typical biotech investor. What I really specialize in is I look for those middle tier companies that are just getting their first drug approval and then have a legitimate pipeline behind them. And in my experience, that's really when these companies bloom. And it's a great time to be buying them because, when biotech companies are always hungry for capital. And
Sure.
when they've reached a point where they have a drug approval and they have some non-dilutive revenue coming in while they're working on a lot of those other things, that's just like the ultimate place for those companies to be. And it's usually where they hit an inflection point. And so one of the strange things I think is, people love to play the binary scenarios, but you can actually avoid a lot of the risk and just, buy things after they've been de-risked, and still the upside is tremendous. A good example, one of the best stocks over the last 5 or 6 years is Regeneron. They have a huge drug called Eylea, which was really one of their first ones. It's for macular degeneration.
So that's REGN, right? Regeneron. I'm pulling it up right now. Okay.
Yeah, REGN. And, that was literally a single-digit stock forever. And then they finally got this Eylea to the finish line, and that took the stock up to like, $60, $70 or so. And everybody had, taken a lot of risk and, followed it from like 8 to 60.
Right.
But what a lot of people didn't see is if you buy it there at 60, you really are taking, almost no risk at all. And that stock's gone from 60 to where it is today.
Well, yeah, what, $415. So that move up to 60 we're looking at late 2010 or throughout 2011 here.
Yep. Yeah, that's exactly right. And so there's a lot of instances like that where, you were really taking a lot of risk betting on that drug before it was approved. But if you bought it immediately afterwards, your risk was much lower and it still had tons of upside. And a lot of people essentially feel like the party's over once that binary event has happened. And
Right.
that's not true at all, especially if you can find quality companies with quality first approvals. That to me is like the ultimate investment in biotech. So I look for a lot of that. I do invest in some other speculative things. If I see a technology that I really like, I'll bet on it over the long term. I think one thing we'll talk about later is like immunotherapy and gene therapy. Those things haven't been approved yet, but they're so exciting. And, I think that I see long term where they're going, that, even though that's not an instance where a drug has been approved, it's something that I'm willing to take, a longer term bet and a longer term, view of.
Yeah. Well, let's break this down then for viewers, right? When you say the drug gets approved, can you educate us on, I know there's the 3 phases, you go through the phase 1, and then phase 2 is a bigger population size, and then phase 3. Can you walk us through that process? And then when does that, is it when it hits, they got phase 3 approval, that's when the drug is approved? Or, how does that process work, Brad?
Yeah, it's an excellent question. It's a good time to be talking about it because it's starting to change a little bit. Traditionally, there's the 3 phases. And so the first phase is the first time that it's given to human beings. And and that's actually the most confusing one to most traders. The first phase is not meant to understand if the drug works. It's only meant to see if it's safe. And so a lot of times you'll see companies kind of take liberties with that, and they'll put out a press release saying, here's our phase 1 results. Don't they look, great? We've got this drug that works. And you really have to look past that because most
Right.
phase 1 studies are just meant to prove if it's safe. And if that works, then in phase two, you kind of go, to a middle tier population.
Okay.
And by the way, another thing in phase one is you're also trying to understand what the best dose of your drug is. And so you get to phase two, and then you start to test that in more people. And that's where you start to really get your signal about whether the drug, is looking like it might, work or not.
Right.
And then if, phase two works and you have good safety and good efficacy from that, that's when you step up to phase three and you test it in a much wider population.
Now,
And
how much wider of a population are we talking? Like 5 people in phase one, 30 in phase two, or 300 in phase three, or what would that look like in general?
yeah, it actually widely varies based on what the indication is. Like, for
Okay.
example, if you're trying to do like a blood thinner, which is, a very common thing that people need later in life, you're going to have to test it in thousands of people in phase three trials.
Wow.
Whereas
Okay.
if you have like a rare disease drug, you only need to, where there may only be a couple thousand people that even have the disease to begin with, then you only need to test it in a handful. And that brings up an important point. One thing I mentioned earlier, we talked about phase one, phase two, phase three. Sometimes
Mhm.
those lines lately are starting to get blurred.
Okay.
And the reason for that is, in medicine and in science, people are starting to understand the molecular basis of diseases much better. And
Sure.
they're able to target therapies much more specifically. And so, like, take cancer, before you had chemotherapy that, was just a broad thing and, affected your entire body. And so, what they're doing now is they're able to kind of target it more specifically for the cancer. And, companies are getting much better at lowering, risk, making things more safe and raising efficacy. And so these days, if you have a drug that's really targeted and, really well understood at a molecular level, sometimes you have some wiggle room about how fast you can go from phase one to phase three. Like, for example, one company that's just been on fire this year is called Agios. The symbol's AGIO.
AGIO. Okay. All right.
and
Wow.
and that one is kind of a new way to treat cancer. It treats what's called the cancer's metabolism. And that's a
Wow.
very targeted drug. That company just IPO'd not too long ago, and they've essentially been able to go straight from what you would consider phase one type trials, and then this year they're essentially going to leapfrog phase two, and so they're going straight to phase three.
So this
And
has
so,
one drug then? So like we're looking at this stock and I'm looking at the weekly chart here, Brad,
Mhm.
and I see that the IPO was back in September 2013. And I also see two secondary offerings here. Now the stock's trading at $120
Isn't that
and it's
amazing?
amazing run. Now, this stock does not have, I mean, does this stock even have revenues? I should pull it up, or is this on one drug, like just the anticipation of this drug getting approved, or what?
Yeah, in fact, they would, it's kind of there's no black and white, it's not gray, but they've essentially done what you would traditionally think of phase one trials
Okay.
for a couple of drugs that they have. And those have looked so promising that again, when I say targeted, that's another thing. That's another thing that's changed in biotech investing these days. These
Okay.
stocks are going up much faster than they used to because this drug is so targeted and people think they understand the mechanism so well. When you have just a small hint in phase one that it's doing what you think it's going to be doing, these days you have a much better understanding and much more confidence that it can go, that you're going to see the same thing in the final study as that you're seeing in this first small little study. And so that's what happened in this case. They've had a
Wow.
couple small little studies and they've been so impressive, and people are so convinced that they'll be able to replicate that in a larger phase three study that the stock's just gone bonkers this year. And that's happened with a lot of stocks. Another one, I'll give you a perfect example of that.
All
It's one
right.
of my favorite stocks. It's called Bluebird Bio.
Oh yeah, BLUE, right? It's just blue,
Yep.
isn't it? Oh
Yeah,
yeah.
Yeah, this one's really neat. They're working on what's called gene therapy. I'm sure you know about everyone's DNA. It's especially the recipe that tells your cells what makes you you.
Right.
And so they're working on genetic-based diseases. The first one is called beta thalassemia, where people who have this can't make enough hemoglobin, which carries oxygen throughout your body, because they have a genetic defect. And
Okay.
what Bluebird is doing is they're taking their bone marrow cells and they're using technology to essentially fix the defect.
Wow.
And then you put it back in the body, and then hopefully you make the right cells, and you're basically curing people. And in this one, you've seen the stock go from like 20 all the way up to 100. And you may not believe this when I say it, but it's all based off of 4 patients.
Oh
They
my God. Wait. Okay, let me take a step back here. So I have this chart up here, Brad. Now, this stock also IPO'd in this, so summer 2013. I'm looking at June here. And yes, I see this. It created a base, it dipped down below $20, and then it just gapped up to 40, did a secondary, did another secondary, and the stock just shot up over 80. And you're telling me that this is based off one drug and 4 patients that have been tested for this so far?
That's right.
Wow.
In fact,
Unbelievable.
last June, you'll see it made its first big jump from about 20 to 40 this
Right.
past June. And what happened is they announced at a medical meeting the results from the first 2 beta thalassemia patients. And what happens when you have this disease, you have to get blood transfusions once a month. And so, in layman's terms, what the company said in June was for the first 2 patients, when they quote unquote corrected their genes, they were able to stop doing those blood transfusions after a matter of essentially weeks. And so
Oh my God.
the hope
Wow.
there was that they were cured. And so the calendar goes along, and the next big medical meeting comes up in December, and they said 2 things. They said those 2 patients still don't need those transfusions, and they said 2 more that we've been working on in the meantime also were essentially, it looks like they may have been cured really fast. And so, this is a company whose valuation is over $3 billion right now. And, biotech is definitely not for the faint of heart. This is a stock that's literally, IPO'd and gone to $3 billion off of 4 patients. And on the one hand, it's, very inspiring and amazing. But on the other hand, it just goes to show why you have to be diversified, and you can't put all of your eggs in one basket. Because, if this company puts out a press release tomorrow that says something like, heaven forbid, one of the patients got terminally ill or died, or, some bad thing happened, that stock could literally go from 90 to 0 tomorrow morning.
Right.
And that would be $3 billion.
So then, and that's good. That's a great point to note, because there's a lot of risk. And you were talking about that earlier, Brad, because you're saying that, you have to you're looking for that moment where they get the drug approved, right? So I guess they pass that phase 3, they go on, and FDA approves this thing. So now a lot of that risk that was taken. So these stocks doing these secondaries, they're taking on what? It could be hundreds of millions of dollars. And that's probably just to fund, I mean, in certain cases, I guess, preparation for the drug coming out. But these phase studies, they are not cheap, right? This is it can be would it be fair to say it's like several $100 million to get through all 3 phases in a standard drug? Or, how much money actually goes into this to get to that phase 3 approval?
Yeah, it actually varies, again, based off of what type of disease you're trying to treat. If it's something, again, like heart disease or diabetes, that affects a large percentage of the population, you have to test it in a ton of people, and those can cost hundreds of millions. There's a lot of studies right now, and it's really hard to know what to believe, but there's some academic studies that have tried to put a number on what it costs to take a drug from day 1 to approval.
Right.
And it's anywhere from 1.5 to $2.5 billion these days. It's totally nuts. But
Oh man.
that's actually starting to change a little bit for the better. And I think it's one of the reasons why biotech is doing so well, because again, when you talk about these companies like Agios and Bluebird, who are able to essentially prove or make a strong argument that they're doing what they're setting out to do with such small patient populations, that makes it so much, it takes much less time and much less money and much less capital to fund that. And so you have a lot of new technologies right now that are really shortening the regulatory path. And that's a good thing for investors because, with a shorter path, the less money that it takes.
Sure. And then naturally, it's not like, so if I'm seeing this theme correctly, and in fact, I think I'm going to try to make this connection here, and you tell me if I'm wrong here, Brad, but the biotech sector as a whole, it's been on a monster run. I mean, actually, I'm going to pull it up right now, and we're going to talk about this because we're talking about the difference between IBB and XBI, but I'm going to throw up IBB here just for perspective's sake. So IBB, this is a weekly chart, everyone, and this is so it starts here at September 2010, and where this is at $80. So the IBB is an ETF that follows the NASDAQ Biotechnology Index, and right now it's at $325. And so this is just a very broad look at what biotech has done as an industry over the last 4 or 5 years. So would it be fair to say, Brad, is that as medical science and these studies and these drugs and how the techniques and how they're able to target, maybe it's through technology or whatever, what have you, it's so effective that they can, I guess, speed along these trials and such, but there's just a lot more confidence in with these drugs going through the pipeline that these companies, I mean, do you feel like that is a part, do you think that's part of that bigger picture on why biotech is kind of, I don't want to say blown up, but it's really been the biggest story of the last, let's say, 4 or 5 years. Am I right?
You're absolutely right. And it's funny you say it. I mean, you hit the nail on the head. This is actually the topic of discussion that's on everybody's mind right now. Half of people in biotech right now think we're in a huge bubble, and the other half think we're in a new day and age, and that the valuations are reflective of the advances, just like you talked about. In fact, at the beginning of January, there's a big biotech conference called the JP Morgan Healthcare Conference. It's like the Super Bowl of biotech.
Okay.
And there was a CNBC reporter there, and she did a great job interviewing all the CEOs. And she essentially asked them, are we in like a new day and age, or, are we in a bubble? And literally, even the people that are running these companies, were divided on that. Some of them, think we are in a bubble. There was a New York Times story where one CEO was quoted as saying he has his crash helmet on.
Wow.
But others, don't feel that way at all. And I'm definitely in the optimistic camp. I mean, the difference is, the way that you measure value in biotech is to what degree you're changing patients' lives. Okay. And in the past, biotech has been criticized a lot because you had a lot of incremental improvements. So like take cancer, for example, you'll have a cancer drug that, on average extends people's lives, maybe 4 or 5 months. And then the next drug will come out and it extends their lives maybe 6 months. And there's been a lot of, even though those things have added up to a lot over time, there's been a lot of criticism that it's been, slow going from point A to point B.
Right.
And the difference that's happening right now is you're starting to see a lot more leaps. And it's always taboo to use the word cure in anything in biotech, and I understand why, for good reason. Mm-hmm. But you're starting to see diseases where there are cures. That Bluebird thing is a good example. These are people that needed blood transfusions once a month for their entire lives, and along comes Bluebird and manipulates their genes a little bit, and then within weeks they don't need any transfusions. And if that's durable and that lasts, for years, and maybe even longer than that, then that's a cure. And then another thing that I think is the most exciting technology in biotech right now is called CAR-T, which is a new way of treating cancer. And it's really neat. CAR-T. What it is they're in your immune system, the attacker cells are called T cells.
Right.
And what CAR-T is, is these companies are able to take those T cells, and in layman's terms, they're essentially able to program them and tell the cells what to look for. And so, for example, the first round of things that they're going for right now in blood cancers, there's a protein that's expressed on a lot of blood cancers called CD19. And so they take these cells and they say, look for CD19, and then just eat up, anything that you see that has CD19 on it. And so for a lot of these blood cancers, these CAR T companies, the results are phenomenal. I mean, this isn't just like extending people's lives for months. These are small studies, but these are studies of like 30 people who have failed essentially every drug that exists.
Wow.
And they're getting this CAR T treatment, and 27 out of 30 of them in some cases are having what's called a complete response, or,
wow.
or a total absence of cancer. And so it's like a brand new day. And stock-wise, I mean, I'm sure you've probably heard this name before. A really famous one lately is called Juno. It's about a $4 billion company. It just went public a few months ago, and already it's off to the races because this is a company that specializes in that. Another one is Kite that went public recently as well. And that one's gone since, maybe September, October, it's gone from 20 all the way up to 90, and now it's pulled back a little bit. But, if the late stage studies of that type of technology looks anything like the early stage studies, I feel pretty comfortable saying that we are in a new age, and that, these valuations and the way that these stocks have been running is well justified, because you're taking people who are, extremely sick, and in some cases, again, not to use that taboo word, but, you're really changing their lives, and just providing so much value that's unlike anything that, drugs, in the past have been able to do. And so there's a lot of promise out there, and it all has to come through. These things are still early. It's like Bluebird, it's 4 patients. They need to study it in a lot more and over a much longer period of time, but it's so darn promising and so different from what we're used to seeing that I can understand why these stocks have been jumping like they have been.
So then these, now for Kite and Juno, do they have separate approaches to targeting these, cells to, or, are they also, can they approach it the same way, or do they have to have a different approach to how they come up with the cure, so to speak?
Yeah, those two, without getting into like the nitty gritty science, I would consider Kite and Juno very similar.
Okay.
Another one that I would look at is called Selectus. It's a French company, and it actually trades right now on the pink sheets because it's one of those ADRs that's weird and has like 5 letters or whatever. But it's going to IPO in the U.S. soon. And one thing for people that are listening, that like one term that I would ask them to listen closely for, there's Kite and Juno, this CAR T technology. The way they're going about it is called autologous. And what that means is they're taking the patient's cells out of them, and then they're manipulating them, and then they're infusing them back in the patient.
Oh my God. Well, that's pretty intense stuff. Okay.
It is. And in fact, for that reason, a lot of people criticize it, because it's not like something that, it's logistically very difficult to roll something like that out. For example,
sure.
One company that everybody's familiar with is Dendreon, that's gone bankrupt this year. Dendreon was actually the first immunotherapy company, and they were also autologous. They had 3 factories throughout the country, and you had to take it, out of the patient, put it on an airplane, ship it through a factory, and then it was like a total disaster. And so they've gone bankrupt. And so a lot of people are wondering if the same thing is going to happen to these CAR T companies. I don't think it will, without getting into some complicated logistics. But there's a second generation of these that are doing what's called allogenic, which is essentially means the same treatment for everyone.
Okay.
And so you want to watch Selectus, and you also want to watch Bluebird, because Bluebird is also getting into this CAR T. And what they're going to try to do is they're not going to try to take it out of the patient, manipulate the cells, and then put it back. They're going to try to use one donor, and then use the cells from that one donor for everybody. And so that's one thing that could
Wow.
really affect those first companies if it actually works. It's much more technically challenging, and so nobody knows if it actually will work.
So it's like kind of like a printing machine. So instead of saying taking each person individually, okay, Brad, here's your DNA, let's process it, let's put it back in you. Okay, Blaine, here's your DNA, let's process it, let's put it back into you. They're going to take one person's DNA, find the right mixture, so to speak, and then they can give it to Brad, Blaine, Joe, Sam, Susie. Is that correct?
Yep.
Then they can.
Yeah.
Wow, that'd be a
That's
huge
essentially
difference.
right. Yeah,
Okay.
yeah. I mean, it would really be revolutionary. But again, it's much more technically challenging, so nobody knows if they'll be able to do it. And those companies are second generation. They're at least a year and a half to 2 years behind. But they're worth putting on your radar because the science that they've talked about does kind of make sense. They need to do some early studies themselves, but those are worth watching because if they're successful, that could really affect the two leaders. And another thing for people that are watching those stocks that's really important to take notice of is right now this CAR T technology is working in blood cancers exclusively. They haven't tested it out in solid tumors like, breast cancer and bladder cancer and, all things, lung cancer and things like that, that we're all familiar with. And that's another question is, does this technology only work for blood cancers, or are they going to be able to do it for solid tumors too? And so that's another big theme. But if somebody was not a biotech person and said, hey, just like for entertainment purposes, I want to follow, what's going on in that sector, give me a stock, I would say Juno, just because it really represents the most promise, but also the most risk. If something goes wrong and it crashes, it's really going to affect it's going to affect the entire sector. That company literally formed about a year ago. It's nuts. It actually raised more money in the first round of private financing of any biotech in history.
Wow.
And it's come public so quickly. And they've just tested this in a handful of patients in phase 1 studies, and overnight it's a $4 billion company. And so
Wow.
there's a lot at stake. I'm a much bigger fan of Kite than I am of Juno, but I'm rooting for Juno because it's one of those things where they kind of have to succeed for this entire sector, because if something bad happens to that one, a lot of other stocks are going to be in trouble. So.
Okay, now that's important because we're talking about this theme, we're talking about biotechs, how they moved over the last 4 years, and you're bullish moving forward. And from what I'm gathering here, like Juno, this is now a $4 billion company. Bluebird, what's the market cap on that? That is
$3 billion.
$3 billion.
Yeah.
Okay. Now, if we go look at a company, some of these leaders that have led the industry of stocks like Celgene, Gilead. Celgene is it's $98 billion. Gilead, this company's worth $158 billion. So these are massive companies. Gilead's known for its hepatitis C drug that just prints money. I mean, the company, for how big it is, the growth story here is just unbelievable. You look at these numbers. But I guess what I'm trying to get at here, Brad, is that you believe that because of technology, because of these studies, because of the way that medicine is being researched and explored, that it's not just it takes the whole industry to move forward. So we're not necessarily, like you were saying, okay, Juno, if this fails, this could affect the whole sector. But isn't that just a little pocket? Isn't there so many other drugs and so many other miniature themes going on, sub themes going along that's pushing the whole industry? What if you took the market caps of all these companies? What are we looking at? Over $500 billion? I mean, it's got to be big, right?
Yeah, there's a couple things that I would say that kind of on both sides of the argument. Juno and Bluebird represent what I think are the two most exciting technologies out there. CAR T for cancer and gene therapy for genetic-based diseases. It's really important that those succeed, that those turn into viable products and succeed, because they really represent what I would term the inflection point of what's going on in biotech right now. They represent the difference between what I said before, the incremental improvements and the giant leaps and bounds.
Mm-hmm.
If those things fail, you're going to start to see, valuations, and things like, you're, you're just everybody's going to price in so much more risk if things like that fail, that it's going to take down a big chunk of the sector. And so that would be a pretty big setback. But if something like that happens, I actually feel pretty good for the long term, because this is an industry that more than anything else has demographics on its side.
Sure.
Over the next 10 years, global healthcare spending should probably double. And you just think about, everybody, like emerging markets and things like that are on everybody's minds. Medicines are one thing right now that's just now reaching some of these developing parts of the world. Even in, big places like China, it's still essentially a nascent industry. They don't have a lot of the high technology that we do. And now you're starting to see companies, have big sales in places like Brazil and Turkey, and, places that, 7 to 10 years ago you would have never even, imagined. And so, like, the entire sector just has demographics on its side. Like, if you only bought the big pharma companies right now,
Mm-hmm.
your Sanofis, your Pfizers, I think they're all good bets, because there's just so many people who are going to be participating in healthcare over the next decade. And, in our country alone, you have such an aging population. And there's actually a huge debate right now. You mentioned Gilead. Well, that's the biggest stock under discussion right now for biotech, because that was the first. It's a single pill that essentially cures you of hepatitis C,
Okay.
in a matter of weeks, and it's actually
Wow.
it's a huge, improvement over what people used to need to do. And it's actually in the first year of its rollout, it's the biggest drug of all time in the first year. But what's happened is there was a competitor called AbbVie, who has a hepatitis C pill, and it essentially cures for the there's different types of hepatitis C. They're called genotypes. And for the most
Okay.
popular genotype, AbbVie, essentially has a very similar cure rate as Gilead. It's just that you need to take a few more pills and a different type of medicine. And there's a big, I don't think controversy is the right word, but what happened is AbbVie talked to, Express Scripts, which is one of the big pharmacy benefit managers, and they negotiated a lower price for their drug so that Express Scripts would cover that and not
Wow.
cover Gilead.
Oh, wow. Okay, that's
And
drama right there.
well, it's a huge, shift. It's a very historical thing, because number one, these biotech and pharma companies have always had pricing power. They've always been able to raise prices, and when they've had new medicines come out, whether this is right or wrong, they've essentially been able to name their price, and historically, payers have had to cover it.
Well, let's say, I mean, just for perspective's sake, for listeners and viewers here, we're talking like these things. Can't they get to like $10,000 a dose or some of these crazy price tags?
Yeah, those two drugs are in the $80,000 to $90,000 range.
Oh my God.
Yeah,
Oh my God.
and
Wow.
it sounds like a lot,
But that's a
and this
cure though, right? It says one
well,
pill.
yeah, it's a cure, and it's not, that price.
Wow.
It's tough to think of drug prices, because everybody's used to thinking a single price for a single thing. You go to a grocery store and, like, bread costs this amount. What you have to think about with healthcare and drugs is, if you didn't have that drug, how much would that patient cost the healthcare system? And so for
True.
people that have hepatitis C, there was another type of therapy that used to take a year, and you had to take a combination of all kinds of different drugs, one of which essentially gave you the flu for an entire year. But that didn't even cure all people. And, you have people that would go into liver cirrhosis and, would need liver transplants and all kinds of crazy stuff. And so when you say, like $90,000 for a drug, it may sound expensive, but if you think, if that drug wasn't there, the healthcare system might spend, $150,000 on that patient over time, or 200, or, maybe even more. And so it's one of those things where it's it's really deceptive. You read the price in the newspaper, and
Mm-hmm.
if you don't know the industry very well, it sounds totally outrageous. But in reality, they're providing good value to the system.
Which makes sense. It's all relative. In the end, it's all relative on what is actually going into this drug to make it happen, which is how they price that. I mean, technically they're naming a price, but obviously they're taking all these factors into consideration before they just say, oh, $90,000. Is that right?
Yeah, that's exactly right. And so this negotiation that AbbVie had with that Express Scripts is a really big news item now for two reasons. Number one, just the fact that they negotiated a lower price than Gilead was charging, and probably AbbVie would have charged if this wasn't this new day and age. The fact that somebody got like a price decrease out of them is news in itself. But the other thing that the industry is a little worried about right now is this Express Scripts said, okay, since you're charging less, we're going to agree to your lower price, and we're going to not put Gilead on what's called the formulary. And so essentially, if you're an Express Scripts customer, you have to go with AbbVie. And that's starting to
Wow.
really scare people because there's a lot. One thing that a lot of people are saying is like, shouldn't the doctor decide which drug you get?
Sure.
But it's also something that's on investors' minds because most people consider AbbVie, or most people consider Gilead to represent the higher amount of innovation. It's only one pill as compared to a handful, and it's a really easy regimen to take, and it cures almost everybody. And so people are a little worried that these payers now are able to essentially not go with the most innovative thing necessarily. The
Right.
Express Scripts would argue that the two are so similar that there's no difference, but that's like a bone of contention. But people are worried about that because think about it as an investor. That would be the most confusing scenario ever because as an investor, like your job is to invest in innovation, and you have to know that you're always going to be rewarded for that innovation. And so if we live in some sort of new day and age where that's not a black and white thing or a straight line between one and the other, then that can be really concerning. And so when AbbVie announced that agreement to begin with, a lot of people said right there, is this the end of the biotech bubble? Is this like the first step of our healthcare system spending a lot less money? And really that debate hasn't been settled yet. We have to see how this works out with other drugs, but I'm of the opinion, investing, you can always look at things from a micro level or a macro level.
Mm-hmm.
Everybody's obsessed with the micro level right now, which
Sure.
is those negotiations that these specific companies are having with that specific payer. But I'm more focused on the macro, which is that we have an aging population. Healthcare is almost, 17% of GDP right now. It's probably headed towards 20, and there's just such a tidal wave of demographics in this industry's favor that, even if the pricing for, a couple individual products is a little confusing, I think the industry as a whole is going to be fine. And that's even more so globally. As I described before, it's global healthcare spending is going to double in 10 years. And so,
And now
this
that
healthcare fund.
Oh,
Go
no,
ahead.
go ahead. Yeah, I was gonna say, so now that bigger picture there, like as an investor, so I'm watching this right now, and I love biotechs, and I'm like a kid in a candy store right now talking to you, Brex. This is so exciting.
Right.
Now, let's talk about IBB versus XBI, because the first way that an investor could tackle this trend, if you believe what Brad's talking about, and you believe that these generational moves and the international growth and all this great stuff coming down the pipeline, that biotechs and general medicine are going to continue to move forward. The bull run has a lot more to go in it. The first natural way would be to say, hey, let's look at an ETF. So there's two ETFs. Now I track, and those who watch the show and everything else know that I like IBB. That's how I look at the NASDAQ Biotechnology Index. Now, Brad mentioned to me, Brad, this XBI. So what are the difference between the two? And let's talk about those to start off.
Yeah, I would. The IBB is highly concentrated, and so I actually don't really like that one. The best analogy that I would use is think of the IBB as kind of like the Dow Jones Industrial Average. It's not price weighted like the Dow is, but it's essentially all the big important companies are highly concentrated, and so they affect it, much more than I think they should. So those companies you mentioned before, like your Celgenes, your Biogen IDEX, your Regenerons, I don't know exactly what percentage they are in that index, but those are probably like some of them are 10% holdings. And so it's very highly concentrated and it's based off of all of those. There's another one called the XBI, which is the Standard and Poor's biotech index. And think of that as like the S&P 500 of biotech. It's much broader and there's much less concentration. And I like that one a lot more. I have another thing about me, in addition to being a long-term investor is, I'm really diversified. I mean, I own probably 25, 30 companies at one time.
Okay.
And as I'm looking at my screen on a daily basis of like, my handful of companies, they much better track the XBI than they do the IBB. And so I think that one's especially if people, are going for, growth and they want to be exposed to some of these smaller companies that may grow into the huge companies one day. The XBI is a much better way to go. It's a little more diversified, but it also is less concentrated in those big behemoths that, don't move as much. And so I would definitely recommend, taking a look at that one.
Okay, cool. Now I have it pulled up here on my TD Ameritrade account, and I'm gonna. They have some good breakdowns on this stuff, and I wanted to see. Let's see here. Where's the portfolio? Okay, and they'll tell me how many holdings they have, because that's an important analogy. So basically, what you're saying is IBB is very concentrated, whereas XBI is a lot more broad. So if you wanted to tackle the larger trend, the bigger picture, your argument here, Brad, is that you would suggest buying the XBI, and I'm assuming as ETFs, the management fees on these expense ratios are extremely minimal, and I'm gonna find these right now. Here we go. Performance, no, ratings and risk. Where is the? They'll tell us our expense ratio. Okay, this is total assets $1 billion. Expense ratio. Okay, so the expense ratio on XBI is 0.35%. That is just negligible. You go buy a mutual fund, it's just such a waste of time. So don't even waste your time with mutual funds. So XBI, okay, that's 0.35%, and then IBB is probably something similar. So 0.48%. So IBB is actually 0.5% management fee per year, whereas XBI is actually even less, and it's more diversified. So I guess there's slightly less risk with XBI. And what you're saying on the side part, then if you wanted to build a portfolio, and this is where I made my mistake. Well, it can work out really well if you do, you pick your great winners, but I was so over concentrated. I was going all in, so to speak, on each of these, biotech companies, and then it ended up burning me. So for you, you're 20 to 25 different investments. Do you, do you try to diversify those out as, if I have $100,000 portfolio, I'm gonna put, whatever, $4,000 in this one, $4,000 in this one, or do you will you make a stronger bet if you have, a really strong opinion about a specific stock?
Yeah, I do place stronger bets if I have a stronger opinion of a stock. I'll give you a good example of my investment philosophy, though. So we were talking about CAR T earlier. Mm-hmm. I'm a big believer that technology is essentially going to revolutionize a lot of different types of cancers. And the thing is, I have favorites. Like my favorite one is actually Kite Pharma. But the truth is, nobody knows who's the winner is going to be. I described to you how there's two different technologies, the autologous and the second generation, the allogeneic, and one might, supplant the other. And so there's a chance that I'm right about this technology, but it would be very easy to get the individual stocks wrong if you're picking, trying to pick winners. And so what I do is I try to buy a basket of all the companies that are involved in that particular technology. And where my big bet comes in is I feel very strongly about that technology. And so I'm placing a huge bet collectively on all of those compared to, other types of technologies. But I very rarely put a huge position in one stock because I just don't have the risk tolerance for that. And that's really how you get in trouble with biotech. It's biotech's one of those things like it's hard to describe why. Some psychologist is going to make a lot of money, figuring this out one day. But it's very easy to fall in love with a biotech stock.
Sure. Guilty as charged, man. I get it. Yeah.
Yeah, and who knows why that is? I think a lot of people, this is so important, to people. In some cases, these are terrible diseases, and you're trying to, help kids, live, longer lives, and it's easy to put your heart into that and to fall in love with a company or a thing. But that is, that is literally the worst thing that you can do in biotech. You have to take your emotions out of it. And even if you do really feel strongly about one, you've got to resist that temptation. These stocks, that I've, Bluebird's, these are all stocks that I love. Bluebird's a good example. I can see a path. Bluebird's a $90 stock right now. I can see a path to 500 because they're working on a second disease called sickle cell disease, and if they're successful, with that, it's just like the sky's the limit with this stock. And so, you think about that, you have like a $90 stock that could go to like, 3, 4, 500, and it's hard not to want to put, your mortgage on that. But
Sure.
you really can't. You've got to be well diversified. And, biotech, as you said at the beginning of this conversation, biotech's been the best sector over the last 4 or 5 years, hands down. Like, it's not even close. Every year it's been the best sector. And the thing is, like, think of how dumb, to use a blunt word, it is to lose all of your money on one stock and see the entire sector just make, year high after year high. All you have to do is just be, exposed to it in general because it's such a neat sector, and try to pick the things that are most exciting and most innovative and most appealing about it, and then you can hopefully outperform a little bit. And I think that's the recipe to success. I know a lot of people that have bet on one company, lost everything, and then the entire sector doubles in the meantime. It's just it's just crazy.
Yeah, well, and I'm reading some of the comments along the way, and some people are initially saying, oh, risk, this seems really risky. But the way you're talking about it, going back to your initial comments, you're waiting for these companies to have, well, first off, you have a diversified portfolio. So it's not like you're saying, all right, Juno, I believe in this is the next big thing. So I have 90% of my portfolio in Juno, I'm on margin. No, you would take a diversified approach, a very calculated approach, and then you move forward. And then secondly, to diversify risk, you're not necessarily buying these companies when they got phase 1 results. You like to wait for companies that have already proven themselves and are at that magic stance where they got that approval, the drug's coming out, now they're starting to make some money, and that removes a lot of that risk. So that makes a lot of sense to me. And then third, if you want to be even more diverse, you can take the ETF approach, and there's 2 fantastic ones. XBI, I'm going to be tracking that now, Brad. I appreciate that. And that's a more broad approach to following the whole trend versus IBB, which is far more concentrated. So all that makes a ton of sense to me, and it seems to me some pretty cool themes here that we all can look and keep an eye on moving forward. And so I wanted to see if anyone, I'm gonna go through the comments and see if anyone had any specific questions. Listening to everything and seeing everything, you guys and gals, on what Brad has been talking about, does anyone have any questions that they would like answered? Because this is, to me, like, I feel like I'm gonna get done with this and then I gotta rewatch it again. I gotta rewatch it because there's so much depth here, Brad. This has just been awesome. So if anyone has any questions, post them up now, and then we will ask the mastermind Brad here. And while people are posting their questions, Brad, you are just so fascinating to talk to. What's the best way to keep in touch with what you have going on? I know you've been on CNBC. I know I can try to catch you on TV. I know you have your blog. Let me pull that up. And you have your Twitter. Tell me, what's the best way to follow your stuff? Do you have a newsletter? Do you have a service? How can people keep up to date with what Brad is going on?
Yeah, thank you very much. No, the best thing is just Twitter. It's my name, Brad Loncar. Very, very easy to remember. I do have a blog. It's called loncarblog.com. And social media, I'm kind of all over on social media. I have a Google Plus account. I have a StockTwits account. I try to stay active on pretty much everything, but I've concentrated all of those things on my website. So if you go to loncarblog.com, you'll see the icons of all my social media addresses, and that's the easiest way to find me.
Gotcha. And then I noticed here too, you have a lot of great blog posts, and this was when I was reading about you initially, I'm like, oh my gosh, because you go to these conferences. This is so important to understand. I'm sure everyone has a very good concept of how much Brad knows about the industry, but Brad, you go to these conferences, and it's not, and I guess this is for the next time, because I definitely want to have you on again if you want to come back on, Brad. But
thank you.
You go to these conferences, and you've actually been an advocate for more transparency within the industry. And I guess I don't want to maybe leave a teaser, so to speak, but you go really in depth. So if you want to read Brad's blog, he has a lot of great content and posts on here. And it looks like you're posting fairly consistency. I know you post when you have free time. You're a busy guy. But there's a lot of good stuff in here as well that I recommend. So we do have a question. Doak asks, can you guys do this meeting every quarter? Well, I think that I would love to talk to Brad every quarter. I think we're definitely, Brad, I would love to have you back on again, just to keep the insights on these trends and keep an eye on what's been the latest, drug results or, phase trial news. I know for sure. So Brad, if you're up for it, whether it be quarterly or once a year or every, I don't care what it is, but I'd love to have you on again.
It would be a pleasure. This is great. I actually just started doing video stuff a couple months ago. And by the way, that's another thing I hope people will look out for. I just started every now and then to record a YouTube video, where I'll throw out a stock that I like, or maybe if there's something interesting in the news, I'll, record a 3 or 4 minute thing giving my thoughts on it. And I just started that, like I said, maybe November, December, and I'm still getting comfortable in front of the camera. I hope I did all right today. But
Brad, well, you know what this leads to, man. If you're going on video, you got Ticker TV. You got to start your own channel. You can make your channel. You could do your broadcast live, then people can ask you questions. I'm sure there'd be a ton of them. And then when you're done, you actually can export the video right to YouTube. It's a double-edged sword. We could be watching the Brad Loncar channel here in no time. You're getting a lot of applause to that. There's a lot of people excited here for that.
It sounds like a match made in heaven. I'm all for it.
Awesome. Then we could do joint broadcasts. Oh, man. Okay, I'm getting way too excited. Okay, one more question here. BJ Rank asks, how much technical analysis is involved? So, when you're looking at these companies, how much, so, I'm like a Can Slim guy, right? I like looking at the charts. I like looking for my cup and handles and my bases and these breakouts. A great example, the best one, let me pull up the chart here while I'm talking to you. Okay, the best one that I found as of late was Gilead. And it had this beautiful cup and handle back in March of 2014, and then it broke out in July of 2014 and went this really nice run up from $85 up to 110, eventually up to 116. So how much technical analysis, if any, is involved in your own research?
Yeah, I was going to say I hope I don't hurt any feelings by saying this, but in my opinion, zero. There are a lot of technical analysis people in biotech, and they're brilliant, and a lot of people know how to do it that way. I don't. I'm 100% fundamental. And that's actually a good thing to quickly talk about because, it just goes to show, you really need to understand these stocks. What I'm doing on a daily basis is I'm taking a company that's, trying to have a drug for an ear disease, and I'm like going through literature and like finding things on the internet. I'm trying to figure out, how many people in this country and how many people in this world have that disease. What are the other drugs out there for it? What's the potential commercial prospects of this? Is it going to have 30% of the market, or is it, a good enough drug to have 60% of the market? And that's all a long calculation that you have to make that brings you to the net present value of the the stock and the company. And so I do very little technical analysis. I try to figure out what's the market opportunity what's the current valuation, and how confident am I that a stock can go from point A to point B. And the other thing that you always have to consider with biotech stocks is they're very event driven. It's based off of when they release trial results, or when they hear back from the FDA about whether they're going to get approved or not.
Right.
And so I know that that's reflected in the chart somewhat, but a biotech stock can be doing like this. It can look like a great chart, but if there's something important happening tomorrow, it can immediately do that.
Right.
And sometimes that's not really reflected in the technical analysis. And so another thing that you've got to do, and that I would definitely recommend to the people out there, you talked about the 3 steps of how to invest in these things. If they go a step beyond the ETFs where they're picking individual names, even if you're a technical analysis person, you've at least got to do the minimum homework to know what all of the important milestone dates are that could, affect the stock significantly, where it might jump up a lot or, might fall down a lot if, things don't go so well. You have to know that stuff very well, because, biotech is not, you can't buy a stock and just like, you can't, I could buy Coca-Cola and not even look at it for 3 years, and then just 3 years later, be happy and look at the price. You can't even do that with a biotech stock for a week, because, anything can happen. You have to know all of the events and all of the risks very well, and you've got to understand what you're getting yourself into.
Sure. Well, and you're talking about these events, and now like when earnings season comes into play, we're always big advocates, whether it be on our market recaps or on air, wherever it may be, is that you have to know your earnings dates. But with biotechs, if what I'm understanding you're saying here, Brad, it's not necessarily just earnings. You're talking about, when is this big drug result coming out? When is this potential news? When is this next big conference coming out where the CEO is speaking? Am I right? It's about those kind of catalysts that can be a huge, have a huge impact on the stock price.
That's exactly right. You've got to know that stuff, with a laser focus, because if you don't, you could wake up one morning and, bad news is waiting for you, and you don't want to do that.
Yeah, no, it makes perfect sense. Brad, this has been, we're only a couple minutes over here, but this has been just awesome. It's been an absolute pleasure. Really appreciate it. Now, again, loncarblog.com. I have the URL up here. You can all definitely read his blog. Send him a bunch of emails, bug him, because he needs to get on ticker.tv. I want to see the Brad Loncar channel, because this just would be, I'd be subscribing in 2 seconds. And then also on Twitter, it's Brad Loncar. I'll post the links again. And, Brad, really appreciate the time. Really appreciate the insight. The educational side of it is just like so exciting. So I wish you the absolute best of success here with your investments in 2015. And I look forward to our next conversation, because there's so much more we can discuss and talk about in this ever-evolving arena of the biotech.
Yeah, likewise. Thanks a lot for inviting me, and good luck to you and everybody out there in their trading as well. It's going to be a very interesting year in the markets with, everything that's going on with oil prices and the Swiss franc and all, China slowing down. There's a lot of volatility going on right now that we're not used to seeing. And so it's going to be a very interesting year ahead.
I would definitely say there's going to be some drama. So thanks again, Brad. We're going to cut it off here. Thanks everyone for tuning in and watching. And click that follow button. I hope to have more great interviews with Brad and others here in the future. And thanks for watching. Again, thanks again, Brad. All right.
Thanks a lot. Take care. Bye, everybody.
See you, everyone.